Have you ever wondered what bonds are and why investors are drawn to them, even in a world obsessed with stocks? Bonds are one of the oldest and most reliable ways to grow wealth, if you understand how they work. Today, we'll break down everything you need to know about bonds, including their types, risks, and rewards. To put it simply, a bond is a loan. When you buy a bond, you're essentially lending money to a government, corporation, or other organization. In return, they promise to pay you back with interest. Unlike stocks, where you own a piece of a company, bonds make you a creditor. When you buy a bond, you agree to lend your money, known as principal, for a specific period. The date when the bond reaches the end of this period is called the maturity date. In exchange, the issuer promises to pay you interest, usually on a set schedule. This regular interest payment is known as the coupon rate. Imagine buying a $1,000 bond with a 5% annual coupon and a maturity date of 10 years. Each year, you'd earn $50 in interest. Once the bond reaches maturity, at the end of the 10 years, you get back your original investment of $1,000, the principal. However, you don't have to hold your bond until maturity. If you want, you can sell your bond on the secondary market before it matures. This flexibility allows you to get back some, all, or even more than your initial investment, depending on current market conditions. We'll talk more about this later. While bonds are often seen as a safer investment compared to stocks, they're not entirely risk-free. One of the biggest risks associated with bonds is the risk of default. Default occurs when a bond issuer, whether it's a government or a corporation, fails to meet its debt obligations, such as making interest payments or repaying the principal amount. Several factors can lead to a default, like economic downturns, poor financial management, and political instability. Throughout history, numerous governments and corporations have defaulted on their bonds. Here are a few notable examples. The Greek debt crisis of the 2010s led to a series of bailouts and debt restructuring deals. The country's high debt levels and economic challenges made it difficult to meet its obligations. In 2008, the collapse of Lehman Brothers, a major investment bank, sent shockwaves through the global financial system. The company's bankruptcy highlighted the risks associated with corporate debt. There are a few main types of bonds, each with different issuers, benefits, and risks. Let's explore some of the most common ones. Government bonds. Issued by national governments, these are among the safest bonds. For example, in the U.S., Treasury bonds, T-bonds, are considered very low risk because they're backed by the government. Other countries have similar bonds, like Canada savings bonds or UK gilts. Municipal bonds, issued by local governments or municipalities to fund projects like schools and highways. The interest earned on municipal bonds is often tax-free, making them attractive for high-income investors. Corporate bonds. Issued by companies, corporate bonds offer higher returns than government bonds, but come with greater risk. If the company fails, you may lose your investment. These are popular for investors who want a little more return with moderate risk. High-yield bonds, aka junk bonds. These bonds offer the highest returns but also come with the highest risk. Companies with lower credit ratings issue them, so they're more likely to fail their bond obligations. Think of these as the wild card of the bond world. When it comes to bonds, not all are created equal. That's where bond ratings come in. Bond ratings show the creditworthiness of the bond issuer. A high bond rating signals to investors that the issuer is likely to pay back the loan. Bond ratings are provided by credit rating agencies like Moody's, Standard & Poor's, and Fitch. Each agency has its own grading scale, but generally, they all use letters to indicate quality. Here's a quick breakdown. Investment-grade bonds are considered safer and are issued by entities with strong creditworthiness, like governments or financially solid corporations. While they offer lower returns, they're popular for conservative investors seeking stability. High-yield or junk bonds are higher risk and offer higher returns. They're typically issued by companies or entities with lower credit ratings, so while they may offer higher yields, they also carry a greater risk of default. Note that ratings can also change over time, so it's important to stay informed about the credit status of the bonds you hold. While bond ratings can be helpful, it's important not to rely on them blindly. The 2008 financial crisis, highlighted in the movie The Big Short, showed how even trusted credit rating agencies like Moody's and S&P can get it wrong. During that time, agencies were rating risky, complex products like mortgage-backed securities as safe investments, due to conflict of interest and lack of full understanding of the risks. So do your own research and look beyond the rating. Here are a few reasons investors might consider bonds for wealth building. Unlike stocks, which fluctuate in price, bonds pay regular interest. This makes them great for investors who want a reliable income, like retirees. Lower risk, bonds are generally less volatile than stocks, so they're often considered safer. Adding bonds to a portfolio can help reduce risk, especially during times of stock market turmoil. Diversification, since bonds and stocks don't always move in the same direction, bonds can help balance out a portfolio. This diversification reduces risk and smooths out returns. Many advisors recommend a mix of bonds and stocks depending on your age, goals, and risk tolerance. A common rule of thumb is that younger investors can invest more heavily in stocks, while those nearing retirement might increase their bond holdings to reduce risk. Tax benefits. In some countries, some bonds, like municipal bonds, offer tax-free interest, which is attractive to higher-income investors who want to reduce their tax burden. Of course, bonds aren't risk-free. Let's look at some of the main risks involved. Default risk, as we already talked about it in details, there's always a risk that the bond issuer won't be able to make interest payments or return your principal. This is known as default risk, and it's higher with corporate and high-yield bonds than with government bonds. Interest rate risk. When interest rates rise, existing bonds with lower rates lose value. This is because investors can now get newer bonds with higher returns. So if you sell a bond before it matures, it could be worth less than you paid. We will dive into this point later. Inflation risk. If inflation rises, the real value of the bond's interest payments may decrease, especially if you're locked into a long-term bond with a fixed rate. Liquidity risk. Not all bonds are easy to sell quickly. Some may have fewer buyers, making it harder to cash out if you need funds immediately. When it comes to bonds, interest rates and prices have an inverse relationship. This means that when interest rates rise, bond prices fall, and when interest rates fall, bond prices go up. Here's why. Imagine you hold a bond paying a fixed interest rate of 3%. If interest rates in the broader market suddenly rise to 5%, new bonds will offer higher returns, making your 3% bond less attractive. As a result, the price of your bond would likely drop if you tried to sell it, so it competes with the new higher-yielding bonds. On the flip side, if interest rates were to drop to 1%, your 3% bond becomes more valuable because it's yielding more than new bonds. This could allow you to sell your bond for a premium, since investors are willing to pay more for a bond with a higher return. So, bond values fluctuate, which is why timing can matter when buying or selling bonds in a changing interest rate environment. And that's how many experienced investors earn money by predicting where the interest rates and market is headed. We can even take it a step further and predict where the interest rates are headed by looking at the bonds that the government is offering. There are a few ways you can get started with bond investing. Buying individual bonds. You can buy individual bonds through a broker or financial institution. This approach is for those who want to handpick their bonds or invest a significant amount. Bond funds and ETFs. Bond funds and ETFs are collections of bonds offering instant diversification and easier management. These funds invest in multiple bonds, lowering the risk if any single bond defaults. Target date funds. These funds adjust the bond allocation based on a target date, which can be useful if you're planning for retirement or another specific goal. If you're looking to invest in the U.S. bond ETFs, there are many great options out there. Here are a couple of bond ETFs to explore. Vanguard Total Bond Market ETF aims to provide broad exposure to the U.S. bond market. Managed by Vanguard, one of the largest and most reputable asset management firms, this ETF primarily invests in U.S. investment-grade bonds across different maturities and sectors, including government, corporate, and agency bonds. Another great option is iShares National Muni Bond ETF, which you would appreciate if you are in a high-tax bracket. It's a portfolio of more than 5,000 municipal bonds. It makes it suitable for investors in a high-tax bracket who want income that is generally exempt from federal income tax. Depending on where you live, Income is exempt from state and local taxes too. The PIMCO Active Bond Exchange Traded Fund is an actively managed ETF, meaning the fund managers select and adjust its holdings in response to market conditions. So it has a bit higher expense ratio compared to passive bond ETFs. It is focused primarily on generating income. It is well diversified, with the bulk of its portfolio consisting of government and government-related, securitized and investment-grade corporate debt. Similarly, there are many good options for Canadians like Vanguard Canadian Aggregate Bond Index ETF, iShares Core Canadian Universe Bond Index ETF, and BMO Aggregate Bond Index ETF, all of which provide exposure to Canadian government and investment-grade corporate bonds. One last tip: if you are planning to pick individual bonds yourself instead of ETFs. Let's talk about bond laddering. Bond laddering is a strategy that allows investors to take advantage of higher interest rates while maintaining liquidity. Here's how it works. Instead of putting all your money into a single bond, you divide your investment across multiple bonds with varying maturity dates. For example, you might invest in 5 bonds, one that matures in 1 year, another in 2 years, and so on up to 5 years. As each bond matures, you can either withdraw the funds or reinvest them into a new 5-year bond. This approach offers several benefits. By staggering maturity dates, you ensure that you have access to some of your funds every year, reducing the risk of being locked into a long-term investment. Bond laddering allows you to capture higher rates on longer-term bonds while still having short-term access to your money. If interest rates rise, you can reinvest maturing bonds into new ones at potentially higher rates, maximizing your earning potential. Overall, bond laddering is an effective way to manage your savings while balancing the trade-offs between returns and access to cash. That's it, everyone. Bonds are a powerful tool to diversify your portfolio, generate income, and reduce risk. If you found this video helpful, hit that subscribe button to learn more about personal finance and your way to financial freedom.